This morning we had a lot of participants from Europe. It's now 9 or 10 p.m. there, and we've had a lot of you join from the US, and we're moving into the part of the session that is sort of focused on the US blockchain environment, and you'll get to meet a lot of our US investors and hear from them. But I wanted to thank you for joining us today. We created this day-long event. As far as we know, it's the only day-long event fully dedicated to how to invest intelligently and using best practices in blockchain, an area where enormous wealth is being created and will continue to be created over the coming decades. I have met many of you and know many of you, but for those that I don't know, I'm Allison Davis, the chairman and managing partner of Blockchain Coinvestors, the firm that Matthew and I founded specifically to provide a high quality investment platform with a variety of investment vehicles and the different sort of blockchain asset classes, and also for those looking to really understand this area of technology and get insights. So hopefully we'll help you with both of those things today. In my case, this came after a long career in financial services and then investing. So 15 years as a strategy consultant to the world's largest banks, asset managers, insurance companies, payments companies. Then as the CFO at BGI, which is now BlackRock, managing trillions of dollars of pension fund assets globally. And then as a private equity GP, with the firm investing in banking and financial services. And then for the last 10 years, entirely focused on blockchain. And also throughout that, I've also been a board director of several of the largest banks in the world, largest payment companies, and investment firms, including firms like Royal Bank of Scotland, City National Bank, Silicon Valley Bank, Fiserv, Janus Henderson Group, Kraken, and Bitwise. Today, a little bit about the firm. Blockchain Co-Investors, I think we're the most diversified platform in the blockchain sector. We have investments in over 1,000 blockchain companies and projects globally, and we are partnered with 40 of the most brilliant and respected venture capital investors in the sector. Many of them you're hearing from on our panels today. We absolutely love what we do. We feel like it's really important, and we're privileged to be part of this ecosystem. So there are two reasons we started the firm. The first is our 100% conviction in the inevitability and importance of blockchain technology. After decades working in financial services sector through many lenses as corporate executives, investors, board directors, consultants, we came to understand that our legacy financial system is built on a increasingly out-of-date tech stack. It requires expensive middlemen, it's creaky, it's not secure, it doesn't work for privacy, it can't handle identity, it's slow, it's inefficient, it's not very client-friendly. A lot of people are cut out of the financial services system, and increasingly it's just very clear it's no longer fit for purpose for our rapidly evolving global digital economy. So since the breakthrough of the Satoshi Nakamoto white paper in 2009, digital monies, commodities, and assets are inevitable. And I think more and more people every year understand that the world's financial infrastructure must be, is being, and will be fully upgraded. So we could spend a lot of time on this topic, but that's not the purpose of today's session. And a lot of you, I think, are already converts to this thesis and, fully sort of understand what we're in the midst of. The second reason we started the firm is because we know from experience how incredibly difficult it is to invest in the innovation economy, and particularly in blockchain with its confusing array of tokens, digital assets, thousands and thousands of new companies forming across the blockchain value chain, infrastructure, consumer plays, layer 1, layer 2, etc. So while there is clearly enormous wealth creation opportunities from investing in major innovation areas like blockchain, early stage technology is actually the highest performing asset class in the world. It's extremely difficult, even for the most sophisticated high net worth families, individuals, family offices, RIAs, and others to access. The challenges include, number one, understanding the rapidly emerging playing field with enormous pace of change, and determining your investment strategy. Number two, accessing good investment strategies. And three, and most importantly from our perspective, getting the diversification that you need to ensure a high probability of getting the asset class return. So these things are the topics and the focus of today's session. We curated today's BlockTalk to walk you through the 6 different asset classes in the blockchain world. My wonderful partner based in London, Mitch Meshigan, who's worked with Matthew and I now for many years, will cover all of this shortly. And then during this morning, we focused on the sort of European environment and blockchain, and you heard from some of our best venture capital partners that we work with, and some of the companies that we and they are invested in. This afternoon, you'll hear from some incredibly high caliber US-based folks. They'll be sharing their wisdom, their best practices investing in the sector, and we hope that when you leave the session, you'll have many valuable takeaways. So I'd just like to say also, many of you on the call have chosen to invest with us across our various vehicles and strategies. Our core vehicles, which are fund of funds, our mid to late stage fund, our token funds. And as you know, our funds with published track records rank among the best performing funds in the world already, and we're very bullish on the opportunities ahead. But we are honored to be working with the most incredible investors, entrepreneurs, engineers, and visionaries in the blockchain world. And we're working diligently to deliver exceptional returns for you. So thank you for your partnership with us. Thank you to everyone who's on for your time today. And now I'll hand over to Mitch Meshigan.
Oh, thank you, Allison. And yeah, this session starts the US-based session. So some of this material might be repetitive. So if you feel that way, you can ask some very hard questions in the Q&A, and we can try to get to that at the end. So again, please listen in and put your Q&A questions into the box, and we'll try to get those answered. So again, for everyone who's just joined, my name is Mitch Meshigan. I'm a partner at Blockchain Coinvestors. So as you just heard from Allison, blockchain technology is a true horizontal innovation that is disrupting several industries and verticals. And as you'll see, there are many use cases, and we'll cover some of those today. However, blockchain is not a monolith as an investable asset class, and it has unique characteristics such as token equity that should be taken into account when you make an allocation decision. So today we're going to try to outline some of these distinct investable asset classes. We outlined 6 within our firm, and then we'll go over some of our own firm's best practices for investing. And again, if you have any questions, please put those into the Q&A throughout the presentation, and we'll try to answer some of them if any time permits. So for the avoidance of doubt, we're talking about investment strategies, but this presentation should be viewed as purely for educational purposes only. You have to make your own investment decision, and nothing here should be construed as investment advice. So why invest in blockchain? Well, we'll just start at the top with our investment thesis, which we think is quite simple. In the early 1990s, the internet digitalized communications and content. But at the time, we failed to digitalize commerce and finance. We actually didn't have the technology in the early 90s for natively digital monies, commodities, nor assets. This all changed after the Bitcoin white paper. So that was published in 2008. And after that, we understood that blockchain technology, which underlines Bitcoin, could actually upgrade the world's financial infrastructure. And that would ultimately lead to natively digital commerce. Because commerce is larger than communications and content, we actually believe that this will be the greatest value creation opportunity ever. So to state it quite simply, we see blockchain technology as an infrastructure technology that will upgrade the world's financial system. And that was only in 2008. So in a very short time, investors have taken note, and we'll get to some of the performance at the end of the presentation. But just to give you an idea of how investors are thinking about this, in a 2023 survey by Institutional Investor, digital assets actually ranked as the third most attractive asset class in terms of risk and return. So you can see that's just behind private equity and US equities. When you actually break this down into institutions, it's even more profound. So 2023 Ernst & Young survey of 250 institutional investors showed that they had an overwhelming belief in digital assets and blockchain technology. And this was particularly focused on tokenization. We had a panel on this earlier today. We're going to have another panel on it during this session of today's conference. So we'll get into tokenization specifically. And likewise, when you look at retail or wealth management advisors, this is a 2024 survey, so just from this year by one of our portfolio companies, Bitwise. You see that wealth management advisors are also mainly increasing investment of their clients' assets to the space, or at least maintaining it. So investors all around are very excited about the space, both institutional and retail. And so what is all the fuss about? Well, a blockchain definitionally is a distributed, decentralized public ledger that exists across a network. Okay, so what does that mean? Well, most simply, we think about blockchains as coordination mechanisms across the internet. Okay, and so what does that mean? Well, for financial products, what that means is that assets, monies, and commodities can now move instantly and seamlessly in a secure manner, right? So you see our firm's core thesis is centered around financial applications. But on top of that, there are actually many other use cases that will likely permeate beyond finance in the coming years. And these include things like identity, gaming, decentralized compute, decentralized social media. Many of these projects are already out there experimenting, though nothing is really caught on in a big way just yet. The core applications today still center around the financial infrastructure technology. And underlying these use cases is a full technology stack. So just like other technology innovations, blockchain has a technology stack. This is similar to other innovation waves, such as the internet. Within blockchain, there's a foundational layer upon which the protocols and platforms are built and operate. There's a transactional layer where digital assets are custodied and transferred. And finally, there's an application layer, where consumers or enterprises actually will interact with applications and products. And, we'll talk about these in many of the panels. We saw some expert VCs join. We'll have many joining later, talk about the areas they're focused on. But what's important to note as you're just coming to the space is that there's a flourishing ecosystem in each of these technological areas. So that means there's a wide investable universe within blockchain technology on all layers of the application or of the technology stack, from application to foundational layer. And there's many, many companies in here, both tokenized and equity, as we'll cover in a minute. So blockchain is very similar to other technological waves in the technology stack, but something that makes it quite different than other asset classes is the token component, right? So we all know equity. Equity gives you ownership, voting rights. It's a fairly standardized security instrument, very codified in jurisdictional law like Delaware LLC. However, tokens are not so similarly defined. So tokens are a unit of account within a public ledger of a blockchain. That's the technical definition. So, right, it's actually just deciding, how many Bitcoins you have, how many Bitcoins someone else has. But new blockchains have made tokens programmatic, which means that there are many different roles within the ecosystem or protocol. So tokens, therefore, could actually represent a security. It could represent equity moving across a blockchain, or it could represent something else entirely. And there is, of course, limited standardization, and regulations are just coming online. So you can see here how we categorize tokens. Again, this isn't all-encompassing, but to give you a frame of reference for how to think about tokens. And you can see the gray ones, the first four, are fairly intuitive as they pertain to products we have in the traditional financial world. So, right, we're simply mapping on concepts of finance, money, assets, commodities, products, and putting those on a blockchain, putting them on chain. So for instance, you see the top one there is a CBDC. We just heard about this in the previous panel. There's a lot of controversy around this, but countries like China are pushing this forward. But basically, a CBDC is a government-sponsored token that is equivalent to a fiat currency, right? So just basically having a token that is equivalent to holding a dollar in your hand. Outside of the public side, we've also seen a large number of very successful stablecoin projects that peg a token to a fiat currency like a dollar. So this would be like a CBDC, except being issued by a central government. It's issued by a private institution. Crypto assets are also forms of digital money, but they're ones that are not maintained by a central authority, right? So you could put Bitcoin in this basket. It's a form of money that's not maintained by a central authority, but rather maintained by a distributed decentralized network, right? So there's no kind of core entity sitting in the middle. And then finally, other tokens in this category you could call asset-backed tokens, and these are tokens that represent some asset or commodity, but travels on a blockchain as well. So we've seen, for instance, tokens representing gold or LP stakes in funds. And basically the benefit of these tokens is that you get traditional financial products, but layered over blockchain infrastructure. And what that means is that these tokens are secured by distributed networks, and they move rapidly, seamlessly, and cheaply. The next 4 tokens you see there in blue are relatively new ideas that are not so easily transferable, right? So we have protocol tokens. These are tokens that can incentivize and reward participants in a protocol. So for instance, if you're developing a new layer 1, you may give some of your early developers, people who are contributing to the code base, tokens in exchange for contributing that code. So later on, these tokens may play a critical role in the ecosystem, and those early developers will gain in the use of the ecosystem. Utility tokens are tokens that users need to obtain, spend, or hold to do something with on a protocol. So for instance, basically they're tokens that have a utility. You need them to do something. So there are decentralized storage protocols out there where you can access some leftover storage that someone has in a decentralized network. And you might need to have a specific token to access that storage. So that token therefore grants you utility by giving you access to storage. DeFi platforms, or decentralized finance, these are protocols that may issue tokens that help either govern the network, so decide the rules of the financial products within it, or they might reward key participants. So if you're an earlier user of the network, you're providing liquidity, they may give you some of this token as well to incentivize that. And then finally, NFTs, or non-fungible tokens. These are tokens that are one of one, meaning that they're tied to a specific digital item. So these are most famously going to be used for digital art or collectibles. So very, very common in the art scene, though there are many other use cases for NFTs as well, including financial. So what's important to understand in blockchain is how equity and tokens are similar and different. And it's crucial to understand this before you invest. So on the screen now, you'll see the typical life cycle for a high growth operating company. And I would say that blockchain equity falls into this category, right? So blockchain equity investing is like investing in previous high growth, innovation wave, high gross margin technology companies, traditional corporate structure, probably a Delaware LLC. And basically at the outset, you have a company that's working on its product and engineering and preparing for the go-to-market. At this time, the company is going to raise capital from friends and family, from angel investors, from seed funds. And most of the time, the company is not going to be making any money at this point, making no revenue. So it's actually going to be burning through cash. Then the project will launch its product, hopefully start to make revenue, roll it out, go to market, and go on its way to cash flow positive. At this time, you often see various professional venture investor firms start making investments at this stage, right? Depending on where they like to play in this cycle. You'll also start to see growth firms and late stage firms later on in this cycle starting to invest. And then finally, if the project's very successful, top 5% of projects, it will have an exit event, probably an M&A, but if it's done very, very well, maybe an IPO or a direct listing or something like this, a liquidity event. Tokenized projects follow a similar path, but with key differences. And again, I think this is pretty critical to understand. And you can see some of the illustrative figures here to give you a sense of how the mechanics and fundamentals work. At the early stage, a project comprises of a core group of developers who want to launch a project that will have some sort of token component. The structure could be very different, right? So you might have a foundation or a nonprofit actually managing the open source code project, or you could have an operating company. Like in the case of Uniswap, you have Uniswap's Labs, which is an LLC structure that basically its purpose is to contribute code to, the code base. Here, the team is also going to go through various rounds of investment, typically with friends and family early on, and then with the professional investors. A key difference to note is that the ecosystem or community will typically get an allocation of tokens. So again, they're going to actually dedicate 30 to 50 to 60% of the tokens to the users of the network. And just like with a successful equity investment, a successful tokenized project will get to its own going public event. This is called the token generation event and signifies when the token goes live and the users of the network can access it. So it's actually often timed with the listing on an exchange, such as Coinbase or Kraken. So again, you can see here the life cycle is fairly similar. It starts with private, you get private rounds of investing, you have a going public event, we have vesting cycles, we have valuation increasing as the project gets further along. But it's quite different in that, a large portion of the project is actually going to allocate its sort of value, its tokens to the community, to the ecosystem, rather than just to investors and the founding team. And this combination of tokens and equity basically gives us our distinct investment classes. And so for blockchain co-investors, we bifurcate this between public and private, and then between equity and tokens. And on the private side, we actually distinguish between early and then mid and late stage because of the different characteristics of those companies, right? Being completely cash burning versus, having actually some revenue. And so how do you access each of these asset classes? Well, there are some similarities and differences. So at the early stage, there are 3 ways to think about it, which are basically equivalent for tokens and equity. So you have direct investments or holdings. These are very difficult to access unless you're very well networked within technology circles. So basically you're an angel investor in this case. Then you have early stage venture funds and early stage token funds. Most blockchain VCs will tend to focus on just equity or just tokens, or have some combination of both. And then finally, you have early stage focused venture firms like blockchain co-investors that will give you access to both tokens and equity, depending on the underlying funds in which they invest. At the mid and late stage, you also have a similar path, right? So you have direct investments, whereby you purchase either equity or tokens directly from a team or project. Sometimes on the token side, you actually purchase tokens directly from a foundation. You have mid-stage and growth and late-stage funds that focus on this asset class. These funds will tend to focus more on the equity side than on the token side. There's just a more traditional valuation framework, right, for cash-generating projects rather than for kind of open source code projects, and also a more standard path to IPO. You also have some crossover from early stage venture firms into these rounds. So these funds might actually hold a portion of their capital in reserve so they can invest in follow-ons from their portfolio at this stage. And then finally, we get to the public side. And here we would say there are some differences between tokens and blockchain equity that you need to think about. For the public to access equity investments, a company actually has to go through a regulatory agency, right? It has to have a public listing event with a document approved by an agency like the SEC, for instance, in the US. These typically will happen in the US via IPO or SPAC, or in some rare cases via direct listing. Once that you have your going public event, anyone can buy it in a brokerage account. And you're also going to have a limited number of ETFs that will try to create baskets of companies that have blockchain exposure to give an investor kind of a diversified basket of exposure. And right now, I would say there's something like 20 public pure play blockchain companies, most of which are Bitcoin mining firms. On the token side, once a project has had its token generation event, anyone can access the token. So you might be able to purchase it directly from an exchange in a similar fashion to a brokerage, so like a Coinbase or a Kraken, but you can always simply just download a wallet that's native to the protocol on which the token trades and actually self-custody the token. So because these networks are permissionless and able to be accessed by anyone all over the world, once a token's live, it's out there in the wild and anyone can buy it. We also now have ETFs globally. So if you're interested in getting token exposure, but you want to have it wrapped in a traditional equity product, you want to buy equity shares that give you exposure to something, those ETFs are available globally. Most kind of famously this year, we've had spot Bitcoin ETFs launched in the US to give you Bitcoin exposure in that form. And then finally, there are crypto hedge funds that focus specifically on trading liquid tokens as well. So again, we think about it as private versus public, equity versus token, and then within private, early versus kind of your more developed companies. At Blockchain Co-Investors, we invest in this asset class. And so where do we tend to focus? Well, you can see it on the screen here. So we focus on primarily the early stage for blockchain equity and tokens, as well as the mid stage primarily for equity. And obviously very central to what we do is the fund of funds. So through our fund of funds, we're investors in more than 40 early stage focused blockchain specific venture firms. You heard from some of them this morning. 1KX is focused specifically on digital assets. Greenfield One will do equity and digital assets. We have some that do equity only. So we think we have a unique kind of access across the ecosystem to both early stage tokens and equity. And then that fund of funds informs our direct investment funds, the strategy for both our early stage token fund and our mid stage growth fund. And so how did we come up with this strategy? What are some of the, kind of rules for the road that we've developed for investing in this space, both into funds and direct? Well, we took most of our strategy as a lesson from, several lessons from the internet era of investing. So specifically, we know that we want to be ahead of powerful tailwinds, right? We know that the internet was the largest value creation event ever, and a very similar disruption is coming to finance and commerce. I mean, you've heard it today from many experts. So we want to position our capital ahead of that shift. Also very important is that we want to be early on the cap table. You've heard it today over and over, but the returns are consistently the highest in early stage venture. So getting access to those early stage rounds where valuations are very low, that's going to generate the top returns. Because we want to be early, access is essential, right? So the best investors are extremely well networked. They're the ones consistently sourcing the top deals. Once you're in that network of top investors, that gives you access to information asymmetries, and that's what we think leads to consistent overperformance, across time, across multiple funds. When we talk about direct investing, co-investing, we want to co-invest with the best investors. So not only do we want to invest in the top fund managers or the top performance, we want to co-invest alongside those investors in later rounds. So manager persistence in early stage venture is extremely high. What that means is that, if a manager is a top quartile fund, it's certainly very likely that their next fund is going to be top quartile fund, meaning that they're going to continue to source the top deals. So we want to be co-investing with these investors. Diversification is also key, right? So early stage venture follows power law returns, meaning that you need to be invested in the biggest winners to have superior returns. So you need to be in the 5 to 10% of companies that are going to generate those large returns. And the easiest way for us to access that is through diversification, right? Very difficult to pick winners early on, but we want to be investing with the best investors at the early stage in a diversified approach. And then finally, you want to try to play market cycles. We want to invest through a downturn, basically. So it's critical to invest when valuations are low and sell, obviously, when valuations are high. What about some specifics? So in terms of fund investing and manager selection, we believe we're some of the most prolific blockchain fund investors in the world, with over 40 investments made. We have a disciplined approach and process. Each manager must pass our filters and coverage screening before moving through due diligence. And specifically, we look at manager reputation, strategy, size, past performance, and then suitability, right? So they have to have a stellar reputation, believable strategy that makes sense based on what they've done in their past. We don't want them to be too big, but we also don't want them to be too small. It has to make sense based on their strategy of their overall AUM. Performance obviously has to have been good, and they have to pass our suitability test as well. Once that screen is made, then we're thinking about coverage, right? So we want to select the right coverage model. And essentially what we want is we want to be covering geographies and investment themes and, making sure we have that diversified basket while also making sure that we're skewed to the early stage. So taking that all together, if a manager makes it through that, that's when we start a robust kind of standard private equity due diligence process. Other key lessons for fund investing, if you're out there thinking about investing directly in a fund manager, what we would say is that, we believe that it's smart in this space to invest into specialist managers, right? So this space is extremely complicated. And for that reason, we don't put generalist technology firms into our fund of funds. I mean, you heard it today from Lassie at 1KS. A lot of the generalist big brand name technology venture funds have tried to cross over and have had, some very big misses and very kind of like, difficult investing track records in the space. It's very, very complicated. And so we think it's important to stick with the top investors who are blockchain crypto native in the space. They're the ones who have the access and the expertise to navigate this complicated space. For our direct token and equity investments, we also have a series of investment fundamentals that we use. So first and foremost, each investment must be at the forefront of digitalization of assets, monies, and commodities. We also want to know that the project is backed by one of our top VCs. So again, we're co-investing with the top managers in the space. Once we're through those two screens, company or project must have a compelling product, strong management team, and attractive return profile. And then finally, it's very important in this space to note that any project into which you invest, you have to think about, how am I going to exit this position, right? So if it's a company that's broken too much regulatory glass, you have to say, can this company legitimately IPO in a top jurisdiction? And that may be a real question in this space. You want to try to avoid investments like that, where the exit's going to be difficult, and stick to investments that have identifiable path to liquidity. And what about the returns? So now you've heard about how we think about this space, but why should you care about this space? How does this asset class compare? Well, on the screen here, you can see a comparison of kind of public comps, right? So you see public blockchain equities and public liquid crypto versus other asset classes. You can see that last quarter returns, last year, and the 3 and 5 year returns. Obviously these numbers speak for themselves. Not only have they been, superb, over the last quarter and last year, but really if you look at a 3 year and 5 year horizon, they've been very consistently overperforming as well. And, as investors and allocators, these numbers are very hard to ignore, right? I think you have to take notice when you look here and you say that this isn't just a flash in the pan. And I think, this page, even speaks to that even more, which is that if you stack Bitcoin up, which is probably the premier asset class, sort of like the industry's S&P 500, and you look at it versus other asset classes over a 13-year period, so since 2011, Bitcoin has been the top performing asset class in 10 of those 13 years. Now, it's also been the worst asset class in 3 of those years as well. So there's obviously, some high degree of volatility with Bitcoin. But I think when you see this, it isn't, just, you can tell it's not just a 1, 2, or 3 year event, right? I think you can see that this industry has some staying power. And I think it's easy to see why Larry Fink, the CEO and founder of BlackRock, has more or less pivoted BlackRock over the last year toward Bitcoin and tokenization in particular, right? BlackRock's launched an ETF, which we'll talk about in later panels. BlackRock has launched a tokenized fund on Ethereum. And I think if you're, the leader of one of the world's largest financial institutions and you see a graphic like this shows you that this industry is really here to stay and also has the potential to generate superior returns for your clients. So that wraps up the content for this section. Again, for those of you who've joined this morning, thanks again for bearing with us on some duplicative content. For those of you who've just joined, the 350 people who've signed up over the course of the day, what we'd say is we just think it's important that before you invest in any asset class, you understand its characteristics. We've tried to lay out our mental model for how we think about blockchain technology and how we distinguish between early, mid, late, and public, on both in terms of equity and tokens. And we hope that this has created a frame of reference for you to start thinking about the space if you're considering allocating capital here. So with that, I think, Matthew, you